Welcome back, fellow value investors. In this video, I'm going to cover the Lumen. This is a high risk stock in 2023. And the reasons for it is that the company has a lot of debt. They are losing customers, revenues are going down, but the stock has just plummeted. It's an attractive stock to those who want a high risk stock. If Lumen makes it, if Lumen recovers their business, let's say in 2 years' time, this is easily a multi-bagger. I don't know if your money would go up 5 times, but it's going to be a multi-bagger, or investors will lose their money. It's that type of high risk stock. I wanted to update my analysis on Lumen, try to value the company, and tell you what I'm doing with this stock. Am I buying shares? Am I holding? Or am I selling shares? I'll take you through that process and share that with you. Do me a favor and like my video and subscribe to my channel. And please leave a comment on Lumen. Let me know what you think, what you're doing with this stock, and I'd love to read your opinions. I'm going to evaluate Lumen on 3 main areas. First is the company. Do I like the business? Do I like the industry? And do I like the management team? Next, let's take a look at their balance sheet, which is critical for Lumen. This has been the main area of my analysis previously because their balance sheet has a lot of important facts behind this company. And the discount. What kind of discount are we getting on Lumen? And then I could decide whether I want to buy, hold, or sell. Lumen provides connectivity. So you could have businesses that need broadband connections with their offices, with the internet. You have consumers that could, in some areas, subscribe to Lumen services and get broadband. It's a business that rivals AT&T, Verizon, even T-Mobile. Lumen doesn't have mobile phone services like the others, but the parts of those businesses, AT&T, Verizon, that do, broadband connectivity are very much like Lumen. The business historically has been attractive, paying high dividends. It's a pretty stable business. Everybody needs connectivity. But this company had a lot of trouble, and the trouble started. The company took on a lot of debt in an attempt to grow, not different than AT&T, if you follow the AT&T story. And if you look at the balance sheets of this sector, the balance sheets look pretty scary, a lot of debt across the board. So those are factors that push me away from the industry. I'm not currently invested in Lumen, AT&T, Verizon, any of the companies in the sector. I once was. I did like the stock back when it paid a dividend. I liked AT&T when it paid a dividend. But the proposition really changed when interest rates really went up. As interest rates went up really fast, debt became a huge burden. And that's the case for Lumen. I think that's what they're struggling with. Debt could cause Lumen to go bankrupt, or the debt is going to be an expensive line on their income statement and be a huge burden because their debt's so big, they're not going to pay it off for 5-10 years. So we'll see how that goes. So the company, historically, I've liked companies like this. Right now, I'm staying away from this industry. Their management team, I'd like to say that they're doing a good job. I think they're in survival mode. Looking at the most recent financial statements, starting with the income statement, revenues are down in the quarter about 17%, and that's expected. They've been selling off parts of Lumen to try to raise capital and pay off some of that debt. For the first 9 months, it's down 19%. So not the biggest problem they have going on. I think if they can stabilize and just not lose any more revenue, that'd be a really positive sign. Something that did surprise me is the number of shares outstanding went down, which is surprising. I guess they're buying back shares at these really low prices. That might be a really good idea. We'll see how it plays out. The company has provided guidance for the full year 2023, and their EBITDA looks good. And again, that was one surprising fact, that if their EBITDA lands between 4.6 billion and 4.8 billion, it's actually a really good EBITDA. And that is, typical of this industry. There is a lot of EBITDA that these companies produce. Cash flows temporarily are going to be really low this year. They're just trying to use cash to build the business where it is growing. They're using a lot of CapEx, and cash flows are down because revenues are down, profitability is down. I think I'm going to take, when I do valuation based on free cash flow, I'm going to take more of an average over the last several years and then take a factor against that, because if I use 0 to 200, I mean, this just would be a very, very low valuation. Looking at the balance sheet, they have very high debt. The debt level is super high, and it's well above the 3 times EBITDA, which is very concerning. The company is losing revenues, they're unprofitable, cash flows are down, and the debt to EBITDA is really high. So that is one of the biggest concerns I have with Lumen. The Lumen leadership is trying to manage their way out of, these rough waters. And one way is by selling off certain parts of Lumen, which is a good idea. Sell off things that you're not going to need with the new company, the new core company, and really generating a high amount of capital. In this case here, potentially generating $1.5 billion. I believe at this point, it should be already done. And that would be a big increase of cash and reduction of debt on the balance sheet. So that would be a very positive move for the company. So it's hard to value Lumen because of the debt, and I'll get into that. Overall, I can't value the company, in positive territory. I'd like to take you through what I'm seeing when I look at valuing the company based on free cash flows and valuing the company based on earnings per share. Cash flows from the, historically over the last 3 years, they've been very good. And I'm only taking about 60% of a 3-year average. So it's a very reasonable expectation that once they get their business back, they'll be around this number, potentially a little higher, a little lower. And just growing those cash flows at a reasonable amount, those cash flows do have value. And a terminal value I'm getting on this particular model, based on a very high weighted average cost of capital, since it is a very high risk company, those cash flows are worth 17.1 billion. But once we add the cash, which is 311 million, and take away debt, which is $19.9 billion, once you take that debt away, you actually have negative equity value. So there's actually, the company's not worth the debt on the balance sheet based on the free cash flow. And this is a very conservative free cash flow projection. And it is a very high weighted average cost of capital, which is discounting all those cash flows to get to this number. The market cap is still hanging in there. But if you look at the discount between the current value of the company and where I think the company's worth, you're actually underwater. It's priced at a premium, a very high premium. But again, it's very hard to value a company like this because you have a lot of big factors that are moving very quickly. For example, the debt. The debt level is above 3 times EBITDA. It's actually a 4.26, which is very high. Earnings per share is expected to be negative for the next 4 quarters by about 10 cents, negative 10 cents per share. And again, valuing based on earnings per share is difficult. Will they become profitable? I hope so. But this just doesn't look really good for the time being. And that's my valuation of Lumen. Over the last 12 months, the Lumen stock has really come down in value. It came down, it was upwards of $6 per share, and it's down to $1.44 per share. So that's a big drop. No big surprise to anybody. It's down by 73%. And again, if there's a path forward and they can make it, really there's upside in the stock, just because this company does produce a lot of EBITDA. If they can somehow get out of this debt level, they could really go up in value, but they could also go bankrupt, because I think the interest rates, the losses, all those things can really begin to accumulate and bring the company down. I'm not hoping that happens. That's just my feeling and my opinion as an individual investor. So let me take Lumen through my evaluation process, starting with the company. I do like this business. Historically, I've liked the business, but the industry right now is somewhat uninvestable. I made my comments around AT&T, Verizon. I'm not an investor in either of those, and I'm not an investor in Lumen. And the company, collectively, the management team really got them in a lot of trouble. So I can't give them a check mark there. Their balance sheet, the debt to EBITDA is too high, way above 3 times EBITDA. And there's no discount in the stock. So I would be a seller of Lumen. I would be a holder of Lumen if I had enough confidence that there was a path forward. And this is how I'm seeing the company. If the story changes, if there's a earnings release or new pieces of information, or if they sell off certain parts of the business and can get on a track to be profitable in the next 2 years, I might be a holder of stock, but for now I'm a seller. So thank you for watching the video. I hope you found it interesting. Do me a favor and like my video and subscribe to my channel. Good luck investing.